Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host David Kaufman, the president of Westcourt Capital. This is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we'll be discussing how to measure and manage risk in a potential investment, including how to determine whether risk is too high relative to possible rewards. But we'll ignore investing for just a moment. In everyday life, David, we're always making decisions based on risk and reward, whether we know it or not, right?
Exactly. Literally everything we do every day involves, even if it's subconscious, an instant calculus of the risk that we are assuming to achieve the reward that we want. So we walk down the stairs, we hold the rail. We get in a car, we buckle up. And that's because we know that there are certain risks that we don't want to undertake, even though there are certain rewards, getting down the stairs or getting to our destination, that we do want to achieve. And what we're doing in that is we're looking at two different kinds of risk. It is the very unlikely to occur event that has a disastrous result, or the more likely to occur event which has a less disastrous result, and so we're more likely to undertake that type of risk.
And an example of that would be what?
The best example of that is airline travel. If you look at what airlines go through in terms of training and redundancy, both with the aircraft at the engineering and construction phase, maintenance phase, and of course the training of the staff, the flight attendants, the pilots, what they're doing is they're spending an enormous amount of time trying to avoid an event that is extremely unlikely to occur, but of course would have dramatic effects if it were to occur. And so what's happening in that scenario is that we get on that plane knowing that we are taking certain risks that may in fact occur. The flight might be delayed. The flight could be bumpy if there's turbulence. We could land in a different destination in the event of weather problems. But we think that those risks are well worth taking because most flights, of course, are relatively on time and get us to the destination much faster than any other mode of transportation would.
Now, I guess another way of mitigating risk entirely would be not getting on that plane, right?
Exactly. Yeah. I mean, what we want to talk about in general, and of course we'll get into investing soon, is that the process of risk measurement and risk management is not about eliminating a risk. It's about mitigating risk. Because even though there certainly is risk without reward, there is no such thing as reward without risk. So the key is to trying to determine the least amount of risk that we must assume to achieve the reward that we desire.
So bring this back to investing. How is this relevant to investors?
Well, keeping in mind that we know that we're going to have to undertake a certain amount of risk to achieve a reward. When we look at any kind of investment, I'm sure that our guest Jason Marks today will discuss this in some detail, we have to establish what reward we want. So we want, if it's equities, we might want a 20% annualized return. If it's fixed income, we might be happy with significantly less, and balance that against, once again, the risk that we have to assume to achieve that.
Now, anything else you mentioned here in terms of risk reward with investing?
Yeah, I think that it's important to understand that it's not only the risk measurement and the risk management that happens before you enter the investment. Investments are like wild animals. They move and they change before the fact, during the fact, after the fact.
Right, they're a dynamic.
They're a dynamic thing.
Sure.
And so what that requires is that we have a tactical approach to risk measurement and risk management so that what was true on day one may no longer be true on day 10. And that's why what we find is that the best portfolio managers, whether it be in a prop desk at a bank or running a hedge fund, are typically the best risk experts, because when it comes down to it, if one is unable to measure and manage the risks appropriately, they may have the kind of returns they're seeking, but when we adjust those returns for risk, which there's a term, of course, risk-adjusted returns, one might find that the person running the portfolio with less expertise in risk will actually have lower risk-adjusted returns in the long term, which will, of course, be to the detriment of the investors.
Okay, David, we'll wrap it up here for now, but we're going to dig deeper into risk and reward and risk management and risk measurement coming up after this with our guest, Jason Marks, CEO and CIO of GMP Investment Management. That's coming up. Welcome back to Alternative Investing. I'm Mark Bunting. With me, as always, is my co-host David Kaufman, president of Westcourt Capital. This week, we're discussing risk versus reward and how to determine whether risk is too high relative to potential gains. And joining us in the discussion is Jason Marks. He's the CEO and CIO of GMP Investment Management. Welcome to the show. Nice to see you.
Welcome. Thank you.
Jason, you have a long, storied history in risk management. Give us some of the, color it in for us. Give us some detail.
For sure. Well, I've been involved in capital markets for 20 years now, as a trader, as a trading desk manager, as a business head, and as a senior risk manager at the bank. In 1998, I was in charge of trading and market risk at TD Bank during the Asian crisis and the collapse of long-term capital. And in 2002, I was in charge of credit risk, also at the TD Bank, after they had just taken their write-downs on their telecom portfolio. As a follow-up to that write-down, we also undertook a review of what was felt to be a risky business and ultimately turned into a risky business, which was the structured credit business at TD, which fortunately we were able to avoid most of the losses that occurred after the fact. I decided in 2007 to take my experience as a risk manager and provide that, make that expertise available to investors. Because as an investor myself, I was looking for somebody to do that for me and was having a very difficult time finding somebody who put an equal emphasis on risk and reward. And I felt that there was a business opportunity to be able to provide that service for ordinary investors. And that was the genesis between the partnership of myself and GMP, which ultimately led to GMP Investment Management.
You clearly had a front row seat. In 1998, we saw the collapse of long-term capital you just alluded to during the Russian debt crisis. And then you had another front row seat in 2007, 8, 9 during the more modern financial crisis. Can you talk about what they had in common and what role risk played in both instances?
Yeah. In both cases, the types of risks that led to the downfall of investors or lenders, if you look at 2002, were risks that I would term as unhedgeable and sometimes unknowable risks. The risks that occurred in 1998 were really about market liquidity. So the models that long-term capital was actually running made sense, and that in the fullness of time, those trades, which they did with a lot of leverage, would have actually paid off. The problem is the path that one would take from the current price or mispricing and the ultimate end price or mispricing that those securities would take. When those securities started moving against long-term capital, they were forced to put up more capital. When they didn't have enough capital, it was like being short-stacked at the poker table. You might have the best cards, but when you don't have enough chips, you can get pushed out of a trade, and that was what drove long-term capital down. Go ahead.
And as when you saw what happened there, and then you saw what happened in the credit crisis in 2008, you took, of course, what you learned, and you've applied that as being a portfolio manager today. How do you go about determining, from a risk point of view and the reward point of view, the suitability of a particular investment with which you're faced?
Well, you have to start out firstly with the fact that each instrument or strategy, depending on how you look at it, has its own risk profile. That there are things that can happen to a single equity or a portfolio of an equity or index which will drive a certain return profile. And you can't just look at history. You have to look at history in its fullest sense. So if you want to understand what can happen to an equity market, you might choose to look at the Japanese equity market, or you might choose to look at the technology equity market rather than just say, well, this is the worst that's ever happened, so I don't think that will ever happen in this market. And then you need to construct, that forms a constraint in how you actually invest, because you have to constrain your portfolio such that if that event was to occur, that you would have a way of avoiding the accident.
Now, Jason, tell us about the four aspects of financial risk that you always look at.
Right. So there are four main aspects, as Mark said. There's the potential size of the loss. That's really what is the thing that I was just talking about before. How much could you lose? What's the probability of that loss occurring? What is the timing? When is that loss likely to occur? Because that probability function is not a static function. It's dynamic. It changes. And finally, and just as importantly, what's your capacity for withstanding that loss? And I'll give you a very simple analogy. I wouldn't want to be running a Lotto 649, even though I know it's a profitable business, because if I sold only 100 tickets and I was unlucky enough that one of those tickets came up, I would be exposed to a loss of $1 million. So even though the probabilities were in my favor, the loss was greater than I could withstand.
And what role does leverage play when you're talking about capacity and discounting the likelihood of the probability of something to occur?
Well, leverage on all investments is the same, right? The purpose of leverage is that it actually helps enhance returns, because the rate of interest that you pay for giving somebody a senior position in that asset is lower than the return you're looking for, so hence you actually get a better return. The problem with leverage is that it exposes you to potentially more risk. You have less room to move. And in the most simple case, if you own your house and you don't have a mortgage, you don't want the price to go down, but if the price goes down on your house, you don't lose your house. You don't have a loan that's greater than the value of your house. Whereas if you have what occurred in the U.S., which was almost 100% leverage, a 20% repricing of your house, you lose your house.
Now, Jason, just as we wrap up this segment here, tell us about the sources of risk. What do you look at? Where's risk coming from?
Risk comes from a lot of different places. I like to, I guess my background characterizes risk really twofold. There's market risk, which is the risk of the price of something going down. So that's not a realized loss, that's an unrealized loss. And then there's credit risk, which is a real loss. And credit risk occurs when a borrower either A, doesn't have the money to make their interest payments, or B, which is more common, which is they can't actually refinance their loan, in which case they have enough money to service the loan, they just don't have enough money to pay back the loan, and they were counting on being able to roll the loan. The second risk is usually the contagion risk that everyone worries about, more than the serviceability risk. All of those two risks are tied together through market liquidity. So sometimes people view liquidity risk as a separate risk, but it is actually the glue that moves credit risk when you're using leverage to make an investment with market risk.
All right, Jason and David, we'll take a short break here. We'll come right back with Jason Marks of GMP Investment Management on how best to manage risk. That's after this.
David Kaufman is one of Canada's leading experts on alternative investing. He's the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, my co-host, president of Westcourt Capital. And still with us is Jason Marks. He's the CEO and CIO of GMP Investment Management. Now, you talked about, Jason, the sources of risk. What are some of the tools that you use to manage and measure that risk?
Well, the most important tool in managing risk is actually experience. One of the reasons that financial crises, and particularly financial crises lately, have been so severe is the growing reliance on mathematical models to measure risk. What these models sometimes do is lull you into a false sense of security. So if your model says that the size of a potential risk is low and the probability of that risk is low, then many organizations or investors feel, well, then I actually have a low-risk investment. That's very dangerous, because that is actually not what these models really do. What they're good at doing is showing you how, along that measure, risk has actually changed. But they aren't very good in telling you what the absolute risk of an investment or an investing strategy is. A better method for determining risks are stress tests. The challenge with stress tests is determining what stress test to employ on your investment portfolio, because the process that a portfolio goes through when it experiences losses is a series of if statements. If this happens, and then if this happens, and that drives this to happen, then this could happen. And actually, given that there are an infinite number of scenarios, that's where one's experience, not just in the market you're trying to measure risk for, but your experience in all markets that you can bring back to this market to say, if this could happen in this market, then this could happen in another market. It's those analogs that really give you insight into potential risks, particularly where that risk is somewhat liquidity related.
Well, you were one of the people that was able to get the if this and this and this then this when you looked at the building credit crisis in 2007, 2008.
Right.
But there's a lot of people out there with PhD who didn't see it that way. What is it that blinded them to the ability to be able to build that function, to be able to determine that the amount of risk that they were actually assuming was unbearable?
Well, really, it was the models actually led to this false sense of security. Everyone ran the same models, and I won't go into the mathematics around the models, but you actually had to take a step back from the models. And I actually believe that part of my experience in 1998 watching the models of long-term capital fail and applying that experience, well, it was a completely different set of circumstances in 07, 08, but applying that experience of liquidity moving positions against an organization that allowed me to be open to the fact that these types of transactions could actually go horribly wrong. And then you can draw on the expertise of other people. Like I would draw on the expertise of the people that worked for me that were experts in credit. And I'd say, could this ever happen in credit? For which they would say yes. And then I'd say, well, I know that if that happens, this will happen, which will mean this will happen, which will trigger this to happen, which is how I came up with the thesis going back to 2003 that there was a lot more risk in these structured credit transactions than the market was pricing into them.
Let's get away from the structured credit transactions and into sort of the more plain vanilla and the kind of risk that's embedded in everyday portfolios. We talk a lot on this show, Mark, about the fact that most Canadians own equities and fixed income, and in most cases they have a 60-40 so-called balanced portfolio. And I'd like you to talk, I know we have a board on this, about what actual risks and rewards are embedded in a balanced 60-40 portfolio.
Right. So just to keep it simple, I decided to look at just a straight balanced portfolio, 60% TSX 60, 40% Canadian Bond Index. And if you kept that allocation completely static, well, as you can see, that in 2007, 2008, even that what supposedly low-risk strategy led to 22% drawdown. An investor in that kind of portfolio needs to be able to withstand a 22% drawdown. If you're a pensioner or if you're living off a certain income, that might not be the profile that works for you. On the other side, the returns that you earn from having that portfolio are only 6.5% per annum. So if you think about it, if I sold a balanced portfolio to you by saying I have a 10-year investment that's going to pay you 6.5%, and once or twice in the 10 years you're going to be down 22%, it'll come back, so you'll be net 6.5%. Would that be an investment that you'd be interested in? I'm not sure that a lot of people that buy into balanced portfolios would say that I'm comfortable living that. And when you looked into people's eyes in 2008, and they were actually experiencing this in real time, there were a lot of people that were very scared that they weren't going to have enough money to live out their retirement. The time to think about that return profile is not once the accident has occurred, once the drawdowns occurred. It's before, to say, well, I know I have this, and I know that sometime this type of event is going to occur, or maybe one that's a little bit worse than that. The good news is that there are other options for people. I mean, as I said, when we formed our business because we felt that we could build a product that would avoid those kind of drawdowns and earn returns that were bigger than 6.5%.
Okay, Jason, let me interrupt you there. How do you do that based on your experience, based on what you just said? How do you construct a portfolio for your clients by measuring all that risk?
So there are two things that we do. One is, and what we do most of the time, is understanding where we are in the cycle, where we are in the business cycle, where we are in the economic cycle, where we are in the market cycle. Because depending on where you are in the cycle, the risk and reward of each investment strategy is different. And we design strategies for different points in the cycle. So I can say that, you know, when you come off of the bottom of a credit cycle, the best strategy is credit. And that's because credit is a contract. All you need to determine then is the value of the hard assets to determine whether you can get your money back. At that point, you don't care whether a company defaults or doesn't default, as long as when they default, you will recoup more than you paid for the investment. And that's why the returns that come out of credit off of the bottom of a cycle are so high. And then they normalize. But after credit moves up to the point that most bonds are trading at par, 100 cents on the dollar or higher, then all of a sudden, even though equities are just as risky or maybe riskier than they were before, on a relative basis, they're less risky than equities. And then as the cycle moves on and you get more through time, and I'm simplifying the process to you, you look more at options, because as a market cycle ages, the cost of buying options actually decreases, even though the risk actually increases.
You're describing, of course, a dynamic strategy, and I want to ask you one question to finish this off, which is, you put so much work into putting on a bet before you place the bet. And how hard is it to get off a bet when you had such a high level of certitude on the way in?
Well, I don't get wed to any position. I think that equity investors tend to get more wed to the fundamentals behind their investment. I think that currency traders, for instance, are in and out all the time. So it's actually not hard. You never get married to a position, and you always size your positions so that you can take the risk down to an acceptable level.
Okay, Jason, we'll wrap it up there. Thanks so much for coming in.
Thank you.
And shedding some light on risk management. Thanks, David.
Thank you.
We'll see you next week. That is all the time we have for the show, but thanks a lot for joining us. If you've got a question about alternative investments, email us at alternativeinvesting@bnn.ca. Thanks for watching. We'll see you next week.